Today we're going to answer one of the biggest questions most investors have at the beginning. Should I buy in my home market or should I invest out of state? What's going on, guys? Chris here from Boselli Brothers Real Estate, and today I'm going to answer the age-old question, where should you buy your rental properties? One of the biggest decisions you'll have to make as a real estate investor is whether to invest in your own backyard or venture out, build teams, and invest out of state. Should you stick with what you know in your home market or venture out of state to potentially maximize your ROI? Whether you're a seasoned investor or just getting started, we'll explore the pros and cons of each strategy and show you exactly what you need to look at to make an informed decision for yourself. Guys, this decision hits very close to home. Being from the Boston area, it is very expensive to purchase real estate around here. So we were hit with this decision almost immediately. Do we stick with what we know and buy properties around here where we can drive to them, get in close contact with the contractors and property managers? Or do we look at potentially investing out of state? This was a scary decision. You don't know what you don't know, and thinking about taking hundreds of thousands of dollars and trying to invest in markets that you don't know or have never even been to is a really scary decision. But the best part is we are going to let you leverage whatever we learned in our few months of doom and gloom thinking and analyzing worst case scenarios about what could possibly go wrong to be able to help you make an informed decision for yourself. In this video, we're going to go over the pros and cons of investing in your home market, the pros and cons of investing in an out-of-state market, other things to consider when making your decision, and how to finally pull the trigger, and if you do decide to invest out of state, what you need to do so. So let's jump right in. First, let's talk about the pros and cons of investing in your home market. One of the primary advantages of investing in your own backyard is having the existing market knowledge you need to make great real estate decisions. You understand all the little nuances of different submarkets, different zip codes, even potentially street to street if you're investing really close to home. This is going to save you a lot of time and effort that you need to put in initially if you're looking at out-of-state markets to help gain that local market knowledge. You will also have easier physical access to properties if you want to go out and participate in the walkthroughs. It will also potentially open up the opportunity to self-manage if that is part of your strategy. And you may have existing relationships with other vendors and contractors alike that would make your investing process that much easier to get started. Some potential drawbacks of investing in your own backyard is you are limited to that local market. This could mean higher prices if you're in an area like we are in Boston, New York City, LA, San Francisco. It could also mean if you're in a market where competition is particularly high, you're going to be competing against a lot of other people in the area and out-of-staters coming in to invest in that area. And a big one is if you live in a market that does not support your specific investing goals or strategies, that's not going to help you out. Good luck trying to find a single family home or even duplex that cash flows pretty well in Boston. Now, let's move on to the pros and cons of investing in an out-of-state market. First, the pros. Some pros of investing out of state is you can select a market that will specifically have more investment opportunities. This could mean just less general competition for investment properties or a lower price point if that's a barrier to entry for you. Investing out of state also allows you to target and specifically select markets that are ideal for your investment strategy. For example, if short-term rentals were something that you were interested in, you could look at seasonal areas like Scottsdale, Arizona, huge golf town, great for people that are coming for bachelor parties for 2-3 weeks at a time. Or even Cape Cod, Massachusetts, where in the summertime you probably can make enough rent to pay your mortgage for the entire year. Or if you're more interested in longer-term holds where cash flow is a big thing for you, then you can invest in some of the lower-priced markets with higher rent-to-price ratios. Another advantage of investing in out-of-state markets is it allows you to spread your properties out and invest in different areas of the country. This gives you a great element of portfolio diversification, so you can spread your properties out around different cities and markets so you can avoid situations like Detroit with the auto crash. And finally, and arguably most importantly, investing out of state allows you to take advantage of emerging markets regardless of where you live in the country. Now, while out-of-state investing has plenty of benefits, it also has several drawbacks that you're going to want to consider. Number one is going to be lack of general market knowledge. We hit this back when talking about investing in your backyard. You have lived there arguably your entire life, or at least for an extended period of time. You understand the different submarkets, the different even street-to-street variations. You're not going to know this going into a foreign market, so you're going to need to build out a reliable team and rely on their market knowledge to help you invest. This could be things like neighborhoods, local real estate laws, landlord-friendly states and other rules and regulations, and more generally, rental market standards or retail market standards if you're looking at flipping property. What do tenants expect? Do they expect you to provide appliances, or in places like Memphis, will people more commonly bring their own appliances into rental houses? Is it standard to have central AC, or is it more common for window units? You're probably not going to know any of this stuff when you're going into a new market, which can be scary, and that's why building out a team that can support you is so essential. This can be hugely important, guys, and you don't want your very first deal to be a disaster by not knowing that a certain ARV or a certain rent number goes down as soon as you cross this certain road or go under a certain overpass. Another con of investing in the out-of-state market is that it makes property management more difficult. This is especially true if you're planning on trying to self-manage properties. Guys, do not self-manage properties out of state. We don't recommend doing it in-state anyways because it can add 10 times more headache. Definitely don't do it out of state. And finally, going into a brand new market usually means you're starting out there with no contacts whatsoever. This means you're gonna have to start out by building out your real estate team. You're gonna need to find an agent, lender, contractor, property manager. Luckily, we have separate videos that do deep dives into exactly where to find and how to interview these individual team members. Now that we've discussed the pros and cons of investing in your backyard versus out of state, we're going to give you some different factors to consider when evaluating your market. Before even starting to evaluate your market, the first thing you're going to want to do, guys, is you need to have an honest conversation with yourself and be crystal clear about 1, your investing strategy, and 2, your target investment criteria for properties that you're going to buy. Don't make the mistake of trying to dabble in everything. As they say, a jack of all trades is a master of none. The same goes for real estate investing. You're going to want to pick one strategy and learn as much as you can about that strategy to become a master in it. Don't worry about if you're going to miss out on something or if one particular strategy looks like it's going to have better returns. You can always pivot at a later date. For example, you're going to think about what strategy you even want to pursue. Are you going to be a wholesaler? You need to think about your competition in these markets. Who else is wholesaling? What percentage of investors versus owner-occupant buyers are in that market? Those are your customers at the end of the day, so you're going to want to know these numbers. If you're targeting to buy long-term hold rental properties, are you going to do short-term rentals or long-term rentals? Are you going to do single-family or multifamily properties? What is your target cash flow amount per door? These are all things you're going to want to know and have clearly defined before you start analyzing your market. If you're going to flip properties, are you going to just be doing simple lipstick rehabs, or are you going to do full gut with a grade A retail product at the end? In either case, what are your target profit margins? These are all going to be important factors when considering if you can invest in your backyard or not. Once you have this strategy and your crystal clear investment criteria selected, now you're going to need to actually look at the market. Some key factors to consider are 1, location. Guys, location, location, location. You're going to hear it every single time you talk about real estate. You want to select up and coming markets with the highest probability of success for your investments. It's extremely unlikely that your backyard is the perfect market for your criteria. If so, that's great, but you're more than likely going to have other areas that are going to be better suited for your investment strategy. Next, you're going to want to look at key economic trends, things like population growth, job diversity, crime, poverty rate, all things that can have a huge impact on your investment returns. Demographic data. Who are your renters? And rental demand. This actually depends on all of the other things I just discussed. Now that you know what to look for, you're going to want to go assess if your home market will even allow you to invest in your own backyard, or if you're going to need to ultimately look out of state. For us, when we first started out, we had this same dilemma. We were looking at investing in our own backyard and quickly realized it was not going to make sense for us. Our primary strategy is value add, long-term hold real estate. And in Boston, just with the price to rent ratios, you can't get a cash flowing property unless you get up to like a 3-4 unit and get it at a significant discount. So we were faced with the decision, we need to invest out of state. Now where do we select? There's 50,000 plus different cities and submarkets in the country we could look at. How do we know which one to choose? Bottom line is it was a very scary process. If you think you have analysis paralysis enough and you're not buying your first rental, spending way too much time analyzing and thinking about all things that could go wrong, multiply that by 10 for out-of-state investments. But the good news is eventually we were able to overcome all that initial fear, set up a rock star investment team in an out-of-state market, and buy our first rental property. Getting the first deal done is the biggest barrier you will have to overcome, and now we've since grown and expanded into multiple markets across the country. And the great news is you can too. So to recap, guys, it's not always clear whether you can invest in your own market or if you're going to need to look at out of state. There are plenty of pros and cons to each, and you're going to need to take a serious look at your investment strategy and your target criteria to understand if your own market is even viable for investing in, or if you're going to need to take that step and look out of state. We are here to make this journey as easy as possible. We are going to provide all kinds of content and show you exactly how we did this same process to make it easier for you so you can avoid the same mistakes that we have along the way. That's going to do it for this video. For more, please be sure to like, comment, subscribe, smash that notification button so you can be alerted whenever we put out new content like this. Head to our website, subscribe to our newsletter for all things real estate. Guys, it's always going to be free information we're trying to bring to you guys, help us reach as many people as we can. And that's it. Again, I'm Chris with Boselli Brothers Real Estate. We'll see you next time.
Woo! Supercharge.
Supercharge. That sounded smart.
That was good.
Throw up
Check it out on the video.
the.